Hello. Today we will be presenting on Chapter 7, Student and Consumer Loans. My name is William Egan, and I'll start it off by talking about things to consider. First and foremost, what is a consumer loan? Well, it's a formal agreement that details the amount borrowed and how to pay it back. It's a step up from something like credit cards because it's more strict about repayment. It's usually used for bigger purchases like homes or cars, and for that reason it's sometimes called planned borrowing, because you need a plan to pay it back so that way you don't dig yourself deep into debt. So there's a few things to consider when signing a loan. I'll touch on each one of them, but they are repayment style, secured versus unsecured loan, rate style, and term length. So the first thing to consider is the repayment style. There's two options here. The first is single payment. This is where you borrow money today and you pay it back later in one lump sum, including interest. It's usually used for short term so that it's less risky. And sometimes people call it bridge or interim loans because they're used until longer term or additional financing is found. For example, if you're building a house and you just need some short-term financing to get you up until the sale of the house, then you might get an interim loan. The next choice you can have is called an installment loan, which is much more common. This is where the borrower makes regular payments, whether that be monthly, quarterly, yearly, or whatever, to pay off the loan. And this utilizes loan amortization. This is the idea that the first payment has the largest portion being used to pay off interest, and then it gradually decreases with each successive payment. The opposite is true for the principal portion, and I'll give an example on the next slide. So here we have the common 30-year mortgage. This is a loan for $275,000 at a 3.7% interest rate. It has payments of $1,258 per month, and as you can see in the first payment, about 2/3 is going towards interest and only 1/3 is going towards principal. In the next couple payments, the interest slowly decreases by about $1 or $2. And then we jump down to the last three payments toward the end of the loan, and almost the entire payment is going towards principal. This is because the loan balance decreases, so there's less interest to accumulate on. The next decision you have is secured versus unsecured loan. A secured loan is backed by some form of collateral that can be seized in the event of default. Secured loans are typically made with homes or automobiles as the asset, but it can sometimes be used with anything with value, such as CDs, stocks, land, or jewelry. Secured loans are safer for the lender because there's less for them to lose, and for this reason, they typically offer lower rates. Be sure to check the terms of the loan, however, because in some cases, if you fail to make your loan payments, then your asset can be repossessed, and if that sale doesn't cover the cost of the loan, you could still end up owing money. Another downside is that it doesn't work in your benefit. If your asset is worth more than you owe, then the lender just keeps the profit. The other option you have is an unsecured loan. These options are far riskier for the lender, so these are only given to people with good credit history. And given this risk, unsecured loans are more expensive and for less amounts. The third thing to consider is the rate style. The vast majority of loans come in the form of fixed rates, meaning that the interest applied to the loan is the same for the entirety of that loan. A variable rate loan, on the other hand, has a changing rate that's usually tied to some market rate, like the prime rate, the 6-month treasury rate. The prime rate is the rate that banks give to their most creditworthy customers, for example, someone who has an 850 credit score. The way variable rates work is stated in the terms of the loan, and it's usually something like the prime rate plus 3% is the rate that you pay. Variable rate loans usually have rate caps, either in the form of period caps, which limits how much the rate can go between payments, or in the form of lifetime caps, which limits how much the rate can go as high. The bottom line for variable rate loans is if rates go up, you lose, and if rates go down, you win. The choice between fixed rate and variable rate determines who bears the risk of increasing interest rates, whether it be the lender for fixed rate or the borrower for variable rate. For this reason, fixed rates are generally more expensive because they are less riskier to the borrower. A third option that's a little more rare is a combination of the two rate styles. It's called a convertible loan, and this is a variable rate loan that can be converted to a fixed rate whenever the borrower chooses. The last thing to consider is the term length. If you get a short-term loan, it means you're paying larger payments, usually with lower rates. And then a long-term loan is the opposite, with smaller payments and a higher rate. To illustrate the difference in just the payments, let's look at a loan for $10,000 at 8%. If you take out a 3-year loan, you're going to be paying $313 per month. And if you take out a 10-year loan, it's $121 per month. It's important to know, though, that the 10-year loan ends up paying a lot more in total. This choice that you have, it really depends on your budget and what you're comfortable with paying, whether you can do the higher monthly or the lower monthly over a longer term. Lastly, there are some special types of loans that you should know about. The first is the home equity loan or second mortgage. This allows you to take out a secured loan using the equity in your home as collateral. Banks will allow for a loan to be about 50 to 85% of your home equity. Because this is a secured loan, it offers lower interest than a regular loan. However, if you decide to take this out, it limits your future financing options, as you probably won't be able to get approved for any other loans until after you pay off the home equity loan. Let's look at an example. Let's say you buy a house for $1 million, and 5 years later, the loan balance is $500,000, but except your home value has increased and it's now worth $1.5 million. If you want to get a home equity loan, and then say you go to the bank and they allow 60% loan to value. So the way you calculate the maximum loan that you could get is you take your home equity, you multiply it by the percentage that the bank allows, and then you subtract out your loan balance. And so in this scenario, the maximum loan that you could get would be $400,000. The next special type of loan is an automobile loan. This is a secured loan that's specifically for a car purchase. So you take out a loan, and then that car is used as collateral for the loan. Lastly, we have payday loans. These are very small, short-term loans. They're meant to cover you for a couple of weeks. The way it works is you borrow $100, you get it now, and then you write a check that's supposed to be cashed in 2 weeks for $115. Except the problem with this is that this comes with an interest rate or implied interest rate of about 400%, and it can get as high as 800%. So you want to avoid these at all costs and try to exhaust all your other options for financing before you get them. These are so bad that they're illegal in some states because they get people into a cycle of having to borrow more to pay off those loans. So if you know anyone that's looking for a payday loan, try to sway them away from it.
Hello everyone, my name is Nikki Ceballos and I'm here to talk to you guys a little bit today about costs and early payment of consumer loans. So there are a couple of questions that you should ask before deciding to borrow money. And these are, what exactly is this loan going to cost me? And what happens if I would like to pay my loan off early? Under the Truth in Lending Act, consumer loan agreements have to disclose in big, bold writing what your total finance charges are, which are the costs associated with the loan, which include interest payments, loan processing fees, fees for credit checks, and required insurance fees. And it is also required to provide the annual percentage rate, or the APR, of your loan. We should know what this is, but it is the simple percentage cost of finance charges over the life of the loan on an annual basis. In case you didn't know what a consumer loan agreement looks like, this is the top half of one. And as you can see, your APR and your finance charges are provided in the form of a loan disclosure statement. It actually says along the left-hand side, Truth in Lending Disclosure. So that is because of the Truth in Lending Act that the lender is required to show you these things front and center when you're signing that consumer loan agreement. So now we're going to get into the cost of the single payment loans, which are just loans in which the borrower pays back one amount at the end of the predetermined period that it is agreed upon between the lender and the borrower. And there are two ways in which these loans are made. So the simple interest method is the method in which principal plus interest are repaid at the end of the period. And interest is calculated as the principal times the interest rate times the amount of time the loan is going to be outstanding. So in this example, the principal is $10,000, your interest rate is 12%, and the time is 6 months, meaning 1/2 of the year. So when you see how the interest is calculated, it is $10,000 times your 12% interest rate times 0.5, because you're only going to have that loan for half of a year. And that comes out to $600 in interest. For the simple interest method, you will receive $10,000 now And then in 6 months, when your loan is due, you are going to pay $10,000 plus your $600 in interest, coming out to a total of $10,600. For the discount method, it works a little bit differently. You calculate your interest the same way, but that interest is going to be taken out of your principal and you are going to receive a lesser amount right now. So in the example for the discount method, your principal is still $10,000, but your interest rate is 11%, and the time that the loan is going to be outstanding is 1 year. So when you're calculating your interest, $10,000 times 11% times the 1 year comes out to $1,100. You will actually receive 10,000 minus the 1,100 right now, meaning you're going to get $8,900 right now. However, you are still expected to pay back $10,000 in 1 year. So payday loans are a type of single payment loan. However, people get caught up in payday loans all the time. They are very dangerous. They are small amounts. However, these amounts can add up if you're not very careful. So a payday loan is usually between $100 and $500, and the due date is usually 1 or 2 weeks after you get the loan. So it's very short term, very small amounts of money, but they are meant to hold you over until your next payday. So the cost of this loan generally comes in the form of a fee. It's usually $15 for every 100 that you borrow. But the borrower gives the lender a post-dated check. Let's say you need $100 and you just need it to hold you for 2 weeks. You are going to write a check for $115. You're going to give it to the lender, post-dated for 2 weeks from now. And then they are going to give you $100 immediately. You're going to receive your $100 now, but you are expected to be able to pay that $115 in 2 weeks. So when those 2 weeks are up, the lender can cash that post-dated check that you gave them 2 weeks ago, or you can flip the loan, meaning that now if I want to have another 2 weeks and another $100, I pay another $15 fee. So the dangerous part of this loan is that if you were to keep flipping the loan over and over again, you can accumulate a lot of money in fees. And when you annualize this rate, you're really borrowing at a rate of almost 400%, which is crazy. So this is just a little table that came out of our textbook, and this is payday loans by the numbers. So like I said, generally it's $15 fee per $100 borrowed, and the median size of a payday loan, like I said, usually $100 to $500, but the median size is $350. So like I said, when you annualize the rate that you're paying on these small loans, you're paying almost 400% APR. It comes out to 391 here in this table. So even though these loans are a small amount of time, the median number of days borrowers are indebted annually comes out to 199 days. So this little 2-week loan can turn into something a little more long-term. And the people who use payday loans on a median generally pay $458 in fees by the time they're done with it. So we have to be very careful, and it is not advised to take part in payday loans. So now we're going to get into installment loans, and this is the simple interest method. So installment loans, your repayment of interest and principal occur at regular intervals, and these payments are fixed, so you will know ahead of time when your loan is going to expire. So with the simple interest method, this is the most common method. The borrower only pays interest on the unpaid balance of the loan. So that means that over time, as you make your payments, the portion of your payment that goes toward interest is going to go down because your unpaid balance is going down. And then the portion of your payment that's going towards principal is going to increase because you owe less and less with each payment. So to the right, we have an example. Let's say you borrow $5,000 for 1 year at a rate of 14%. You're going to calculate your monthly payment. You can do this on a financial calculator. you're actually going to put 12 for N because it is 12 months. We're calculating the monthly payment. And then the interest, instead of putting 14%, you're going to divide that by 12 because it is 12 months. And that comes out to 1.1667% per month. Your present value is $5,000. Your future value is 0. And then in your financial calculator, you're going to get that payment of $448.94 per month. And as long as there are no non-interest finance charges, your APR should be equal to the stated interest rate, meaning that your APR and your stated interest rate are both 14% in this example. So now we get into the add-on method for installment loans. This is a little bit more complicated, but bear with me, we're gonna walk through it. So your interest charges are calculated using the original balance. So you calculate interest the same way that you would with the simple interest method, meaning $5,000 times 14% times the 1 year that you're gonna have this loan outstanding. That'll give you $700. So your monthly payment for this loan is going to be your principal plus your interest, meaning $5,700. You're going to take that, you're going to divide it by the 12 months, and that's going to give you your monthly payment of $475. Now, it is important to note that when you're paying $475 a month versus the simple interest method, which you were paying $448.94 a month, you're obviously paying a little bit more monthly in the same amount of time. And that is giving you an APR of 24.91%, almost double of what your APR is in the simple interest method. And that is due to the fact that you are paying interest on the original principal over the entire life of the loan. In the simple interest method, your interest goes down as your unpaid balance goes down. So let's say that you wanted to pay off this add-on loan early. You've been paying your $475 for 6 months and you want to pay it off. So you need to figure out how much you still owe. There are a few steps involved. We're gonna go a little bit slowly, but we're gonna get there. So step 1 is you're going to sum the month's digits for the entire life of the loan in descending order, meaning that month 1 is 12, month 2 is 11, month 3 is 10, all the way down to 1. And that adds up to 78, or you can use the formula right underneath, which is n over 2 times n plus 1. That'll still give you 78. Step 2 is summing the digits only for the remaining months. So you've been paying for 6 months and you have 6 months left, which means you're going to go 6, 5, 4, 3, 2, 1. That'll give you 21. Step 3, you're going to take your result from step 2 and put it over your result from step 1, meaning the remaining over the total. Gives you 21 over 78. Step 4, you take this 21 over 78 and you're going to multiply it by your total amount of interest, which we calculated earlier to be $700. 21 over 78 times your $700 is going to give you $188.46. Now you can take this $188.46 and you're going to subtract it in step 5 from the total amount of your payments that you had remaining. So if you were to pay that $475 for the remaining 6 months, that would give you $2,850. You subtract the $188.46 from the $2,850, and then your payoff for this add-on loan is $2,661.54. So this is a little bit more about the rule of 78, which is also called the sum of the year's digits. It's a rule that determines what proportion of each loan payment goes towards paying interest and what proportion goes toward paying the principal. In this example, you borrow $1,000 at a 9% monthly rate, not an annual rate, a 9% monthly rate, and it is payable in 12 months. To compute your monthly payment, you can use a financial calculator. N is 12, your interest monthly is 9%, your present value is 1,000, future value 0, and that'll give you your payment of $139.65. Now, to compute your total interest, you're going to take that $139.65, and then you're going to multiply it by the 12 months that you're going to be paying that. And then you subtract the original 1,000 from that. And the total amount that you're paying in interest is $675.81. The third component to that is finding out your interest in any given month, which there's a formula here, 13 minus whichever month you're in, over 78 times your total interest amount. So right underneath, this is an example. If you were to calculate interest in month 7, you're going to do 13 minus 7, put that over 78, and then you're going to multiply that by that total interest amount, and that'll give you $51.99 for interest using the rule of 78 method in month 7. Then you can compute your balance at the end of month 7 simply by following this formula underneath here, which is taking your balance in month 6 and then subtracting payment minus your interest in month 7 from it. So that in this example is $655.96. And then you're going to subtract your monthly payment minus the interest from the $655.96. And that leaves you with your balance at month 7 being $568.29. Now I'll be passing it over to Haley, who's going to talk to you guys about getting the best rate on your consumer loans.
Hi everyone, I'm Haley, and I'll be covering the topics of getting the best rate on your consumer loans and controlling your debt. Where should you go to get your loan? You want to make sure that you're going somewhere to getting the best rate, and there are different types of sources for loans depending on your costs and needs. First, we start the inexpensive sources. There are family loans, and with family loans, you're not paying the market rate, you're paying the rate that your family would have earned if they would have kept the money in a savings account. The only disadvantage is that people can feel bad borrowing from family, especially if they can't repay them. Then there are home equity loans, where you have assets tied up as collateral, like your home, and if you default on the loan, then the lender gets that asset. Another disadvantage is that you cannot take out an additional loan on this asset, so it limits your financial flexibility. Then there are cash value life insurance loans, and these have the lowest rate because it is the lowest risk. You're just borrowing against the insurance policy that you have with the company. And if you do not repay the loan, then your benefit is just paid out lower. Then there are the more expensive sources, such as credit unions, saving and loans, and commercial banks. And with these sources, the cost depends if the loan is secured, you have an asset tied up as collateral, or unsecured, the length of the loan, and the rate if it is variable or fixed. And then rate and cost can also just differ from place to place depending the bank you go to. But credit unions usually have the lowest rate and the best customer service. But again, you have to be a member of the institution to borrow from there. Then there are the most expensive sources, retail stores, finance company, and small loan companies. And here you want to have a good credit rating to borrow from these places because the lower your credit rating, the more expensive it is going to be for you to borrow. Key to getting the best rate, you want to have a strong credit rating, and the loan must be relatively risk-free to the lender. You want to use a variable rate loan because with these rates, if it increases, you're the only one that suffers and not the lender. And they're going to charge you a rate based on the market if it is going up or down. But if you cannot afford an increase in rates, then you should not go with a variable rate loan. You want to also keep the length of the loan short term because the interest rate will decrease as the length of the loan and the time left on it decreases. And there's also less of a chance that you default on the loan and that a financial crisis or emergency will come up where you cannot pay. You also want to provide collateral, such as your home, real estate property, or car, because this makes it more secure for the lender because if you default on the loan, then they get this asset. You also want to have a large down payment because the larger the down payment, the less you have to borrow and pay, and the more you own of the asset for which you are borrowing for. And this usually drives people to pay off the rest of the loan so that they can continue to own this asset. Should you borrow, pay cash. Remember, think before you borrow and do not just borrow because you want to get those new shoes. Debt is expensive and it can prohibit your future financial flexibility. You're not just paying for the cost of the purchase, but you're also paying interest on the loan. You should use cash if you will still have enough liquidity after the purchase in case of an emergency. You want to be able to have access to this cash. If the benefits outweigh the costs, then borrow. If the interest rate to borrow is lower than your savings account, then it makes sense to borrow. For example, if Ford is offering 0.9% financing on a new car and you are earning 3% in your savings account, then it makes sense to borrow and continue to keep your money in the savings account earning interest. Next, we move on to the topic of controlling use of debt. Your first step is to determine how much debt you're comfortable with. This may change as you go through the different financial life stages cycles. And also, as you get older and income increases, debt as a portion of your income decreases. There are two measures to help with controlling your debt: the debt limit ratio and the debt resolution rule. The debt limit ratio is a percentage of your income taken up by non-mortgage debt. It is your totally monthly non-mortgage debt payments over your totally monthly take-home pay. And here, mortgage is not included because it is measuring your commitment to consumer credit, which is usually more expensive. You want to keep this ratio under 15% so that you have room to borrow in the future in case of emergency. And it shows that you do not have too much of a high commitment to consumer credit, so lenders will still lend to you if you have emergency in the future. If you're over 20%, your financial planner may advise you to limit your borrowing in the future because this could limit your future financial flexibility. And as the ratio increases, your financial flexibility will decline. Then there's also the 28-36 rule that lenders look at, is that your monthly mortgage payment is below 28% of your monthly income and your monthly debt is below 36% of your monthly income. If you follow this rule, it shows lenders that you have a good credit rating and it makes them more favorable to lend to you. Then there's a debt resolution rule, which forces you to pay all your outstanding debt every 4 years, and this excludes education and home financing loans. The idea behind this is that your loan should be short-term and over 4 years is considered long-term. Also, your debt should fit your budget and financial goals. Remember that borrowing is expensive and it can hinder your future financial flexibility if you borrow more than you can afford. And then in the future, you might not be able to borrow in case of an emergency. Clues or questions to ask yourself that you might be in trouble are: do you have little or no savings? Have you been turned down for a loan? Are you uncertain about the total amount of your debts? Have you had more than one check returned because of insufficient funds? If you can answer yes to these questions, then you might be in trouble. What to do if you can't pay your bills? First, you should go to your creditor, go to the bank where you owe your money, and see if you can restructure the terms of your debt. You can also go to a credit counselor, which is a trained professional in developing budgets and programs to repay debt. But you want to make sure that you're using a reliable one. So you should call Consumer Credit Counseling Service, go online to the National Foundation for Consumer Credit, or check reviews at the Better Business Bureau. You also want to borrow inexpensively and avoid small loan companies because they can charge up to 40% on loans. Another thing that you can resort to, but you should not do it all the time, only do it as a one-time thing or a case of emergencies, is using your savings to pay off debt. A time when it could make sense is if you are earning 4% of your savings account and your loan that you're borrowing or your consumer credit loan is 10%, then it may make sense to use savings to pay off the loan, pay off the debt in this case. But really, again, remember to think before you do it. Then there are debt consolidation loans, and these basically restructures your debt payments. But again, you want to make sure that you check reviews at the Better Business Bureau and check the Consumer State Protection Office to make sure that you understand the loan and the company where you're borrowing. But the best solution is to take control of your debt from the beginning. Now, bankruptcy as a last resort. This does not wipe out all your obligations. You still have to pay student loans, alimony, and tax liabilities. Leading causes of bankruptcy are major illnesses because hospital bills can be expensive, and you may also lose your job and source of income if it is severe. Credit. The availability of credit makes it easy for people to borrow more than they can afford to buy the fancy car, the fancy house, etc. Divorce is also expensive with the lawyers on top of alimony and child support. And job loss can lead you to use your savings to pay all your bills if you have no other source of income. There are two types of bankruptcy: Chapter 13, the wage earners plan, and Chapter 7, straight bankruptcy. Chapter 13, the wage earners plan. To file, you need to have a regular income, secured debts less than $1,149,525, and unsecured debts less than $383,175. This lets you redesign your plan to pay your debts. And these numbers are from 2014, and sometimes they may be adjusted for inflation. And with Chapter 13, you still own your assets, so you're able to pay off your debts while paying your normal expenses. And usually these people file if they can still afford to pay their expenses, but they're just having trouble with their debt. And it is ease of mind for the lender because it is schedule of repayments supervised by the court. And for you, it's an ease of mind because of how you'll pay your bills and there's a set plan for you. Now, Chapter 7, straight bankruptcy. This is much more serious, and the individual is able to totally eliminate all their debts except for student loans, alimony, tax liabilities, and the non-exempt property will be collected and sold by the trustee, and the proceeds will go to the creditor. And the assets that you can keep may vary from state to state, but there is the home equity exemption. And home equity is when the value of your home is worth more than the balance of your mortgages. And the value of the exemption may vary from state to state again, but if you qualify, then they cannot come after your home. You also have to pass the means test, which determines if your disposable income is lower than your qualified monthly expenses. And you will not qualify if you make more than the median income in your state. You make more than $100 a month of disposable income, and you have enough disposable income to repay 25% of your debt over 5 years. However, if you do qualify, you will need to complete a credit counseling course within 6 months to understand the consequences of bankruptcy. And you will also need to complete a personal financial management course. This is just a little visual and chart again to highlight the differences between Chapter 7 and Chapter 13. Chapter 13 is really for those who want to keep their assets and who really can pay their living expenses, but they're just having trouble paying their debt, and it just reschedules those debt payments. Chapter 17, you have to pass the means test, and is really for those who are not getting enough income and really cannot afford to pay their debt, and most of their assets will be collected. Thank you guys, that's the end of my presentation, and next I'll be passing on to Ro.
Hi guys, I'm Rahul, and I'm going to talk about the alternatives for financing a college education. So right now there's two important factors into this equation, and that's the choice of your school and the desired major that you're going to want to pursue, and I'll get into that a little later. Other things that are important to look at are optimizing the true cost of going to college. That includes, your rent, your cost of living, depending on if you're in a city or a college town, stuff along those lines, and including your tuition. Managing your college budget and optimizing your financial goals while having student loan payments. So here I just wanted to start it off by showing you sort of how higher level education impacts the unemployment rate and your earnings for just your reference. And it's interesting because it shows that doctorate degrees have a 1.1% unemployment rate and around a $98,000 average median earnings. But you'll see that as it goes higher and higher, the change is less and less, right? So the professional degree has 1.6% unemployment and a $97,000 around $97,000 median earnings, which isn't much different. But as you go down, you see the variance starts to increase. Now, back to the main factors, right? What school do you need to go to and what major is right for you? That really matters because, for example, in-state schools are far less expensive than out-of-state schools, which might matter if your major doesn't project you to make much after your undergrad degree. So let me give you a real life example of, let's say, a student pursuing an art major and he or she is on student loans. Perhaps they might be more inclined to looking at in-state options for college simply because art majors aren't projected to make much after they graduate from college. And because of that, they might not have the borrowing capabilities to allow them to go to out-of-state college. So it might be way smarter for them to just stay in state and save up that money. Whereas opposed to a finance major, let's say, projected to make around 60 to 70,000 a year, maybe it would be worth their time to go and pursue college out of state for a better education because they have more ability to borrow money and pay off those loans after their college career. So let's talk about how to optimize borrowing. So there's important factors. Those are comparing the financial aid packages and comparing the cost of the college. So there's resources that are very helpful to research all these factors are the US Department of Education's financial aid shopping sheet, and the Consumer Financial Protection Bureau's Comparing College Costs and Financial Aid Offers worksheet. And essentially, both of these will give you a better understanding of comparing the tuition, fees, student expenses, financial aid, retention, and graduation rates, and just the total net price of going to college and what's that going to cost you. So those are really helpful. Now, when we're looking at how you're going to pay for college, there's two things. There's grants and then there's loans. Grants are the ones you want to go for first, simply because you don't have to pay that money back. It's yours to take, yours to spend. So obviously those come first, and you should be looking at those. The U.S. Department of Education state grants and free scholarships have a few good options. The famous ones, or the more known ones, are the Access to Better Learning Grant and the First Generation Matching Grant, which essentially allow you, let's say if you're a first generation college student, to gain access or to be entitled towards grants for those situations. On top of that, there's tax credits, such as there's federal tax credits that you can claim with student loans as an expense. However, you must have those expenses uncovered by the grantor scholarship. You can't double dip, essentially. And so the two common ones there are the American Opportunity Credit, which is around $2,500 a year, and then the Lifetime Learning Credit, which is all around $2,000 per year. So along with this, it's kind of important to know that maybe even though you don't necessarily need to file a tax report because you're below the income level, it might be useful for you so that you can take advantage of these tax credits. So let's talk about the grants and the work-study funding process. Essentially, to apply for these, you need to fill out a free application for student aid, which is known as a FAFSA form, annually, because you need to apply for these grants annually. And then you must report your income from the tax returns dated 2 years prior to your enrollment. After that, that FAFSA form is sent to colleges and determines how much aid you're entitled to. In the form of the student aid report, is basically summarizes what FAFSA, what you applied to, what you put in the application for the FAFSA. You will see the expected family contribution, which determines the eligibility that you have for federal student aid. And after you're done with that, you'll receive your college acceptance, and in that award letter, you'll see the amount of aid that you're entitled to, the grant work study aid that you received, and yeah, it's just important to know you don't need to pay them back. So these are the ones you go for first. Now, let's say you filed all the grants, but you still have loans. That's a position that 2/3 of students at college are in right now. And half of the colleges use front-loading grants where the aid decreases gradually over 4 years. So you get way more freshman year than you do as you progress through your college career. So I just included a little image down there just to kind of highlight just how big of a float the student debt is, how popular it is. Around 54% of college students taking on student debt, close to $40,000 is the average amount. And there's still 14% of adults with the student loan. So it's still pretty common, and it's a huge float. So now I want to talk about paying for your college. And you're taking on loans. There's the 529 plan, which is a tax advantage savings plan that encourages savings for future college costs. And it comes in the two forms of a prepaid tuition plan and a college savings plan. So the college savings plan permits a college saver to establish an account for the purpose of paying for like your future eligible college expenses, such as tuition, books, room and board even. And the withdrawals from the college savings plan can generally be used at any college or university. For the prepaid tuition plan, they generally allow college savers to purchase units or credits at a participating college and universities for future tuition, and in some cases, room and board. But most prepaid tuition plans are sponsored by the state governments and have residency requirements. And many of the state governments guarantee investments in prepaid tuition plans that they sponsor. So other than the 529 plan, there's also the Covered All Education Savings Account. which allows you to make an annual non-deductible contribution of up to $2,000 per year per person to specially designate investment and trust accounts. The account will grow free of federal income tax with tax-free withdrawals, and its main advantage is that it can be used for elementary and secondary as well as higher education purposes. So this will apply for your grad school, your doctorate if you want to pursue that. So it's really useful. And then the contributions stop when the student turns 18, and they must use all of the money in that account by the time they're 30, or else they'll be charged a penalty as well as taxes on the money saved. So you should use it up if you can. Right here is just another little list kind of explaining you the differences between the 529's plans and then the covered all education savings account. I think just the important things to know is that all three of these have it so that the earnings grow tax deferred and are tax free if you use for qualified educational expenses. So they both have federal tax advantages. However, the covered all educational savings account has no state tax advantages. So you don't get the benefits of that. So let's now talk about, you got the grants. Now you need to figure out how you're going to take the loans. There's essentially two options. You either take a federal student loan or a private loan, and you want to take the federal student loan first. This is because it's provided straight from the US Department of Education, and it gives you the option to reduce or postpone payments. They have fixed interest rates, and whereas the private loans, they're offered by traditional lenders like commercial banks and credit unions, and the interest rates on those as a result are variable, which means that your payments could go up over time. And also the big thing is that they generally do not provide the option to reduce or postpone payments in private loans. So it is best to go with the federal student loans. So let me talk to you about the 4 direct loans that are a part of the 4 different types of federal student loans. There's direct subsidized loans, direct unsubsidized loans, direct plus parent loans, and direct consolidation loans. So for direct subsidized loans, they're only for undergrads. The government pays the interest on the loan while the student is in school during a 6-month grace period following graduation before the student starts loan repayment. And the annual reward for those, as you see, gradually increases as the years go on. And the direct unsubsidized loans are for undergrad, grads, professional students, all of them. And you don't need a financial need to apply for the loans. So if a student wants to not pay interest while in school or during the 9-month grace period after graduation, the interest accumulates and is added to the principal of the student's loan. And the annual reward for these are around $2,000 in addition to the subsidized limit. But for independent undergrads, it's $6,000 to $7,000. Direct plus parent loans, parent just meaning that it's your parent paying for it rather than you, are for graduate or professional students. And direct plus parent loans are made to the parent of the dependent undergrad student. A credit check is required. Interest payments begin accruing immediately, and payments are deferred for 6 months. And the annual reward is the maximum cost of the attendance minus any other costs. And then lastly, the direct consolidation loan is simply a combination of all the federal student loans. So the annual award is the total of all the federal loans without any of the private loans or that you want to take included. So now let's talk about the interest rates, because even though these loans have fixed rates, the federal ones, they're still subject to change. And essentially, every year on July 1st, the interest rate on the new loan changes. And the rate is pegged on the 10-year Treasury note plus an add-on referred to from the Bipartisan Student Loan Certainty Act of 2013. And essentially, the way it works is it's the federal loan rate is the 10-year Treasury note plus the add-on that they decided in July 1st. So for currently direct subsidized loans and unsubsidized loans, it's around 4.9% because the current 10-year Treasury interest rate is 1.34%, and the add-on is currently 2.75%. For unsubsidized graduate school loans, it's 5.64%. And for direct plus and direct plus parent loans, it's 6.64%. So it's just important to note that under normal market conditions, interest rates keep rising, and that causes, you might have to think about that or plan that in your future, while you're in college. But there is a cap to how far these rates could rise potentially, and that ranges from 8.25 for the direct subsidized loans to like 10.5%, respectively, for the direct plus loan plus parent plus and plus parent loans, with the direct unsubsidized graduate loans capping off at around 9.5% as well. It's also important to note that these interest students take out the loans annually, so the interest rates increasing, or the add-on amount increasing does matter. And here I just had a little chart showing you the differences between federal student loans and private student loans as I get into them. And really here it's important to realize that basically the fixed interest rates versus variable interest rates is a big difference. And also that the tax interest can be deductible for both of them. So now let's talk about managing your money. We got the grants out of the way. We got the student loans out of the way, private loans. So once you've made your loan decision, you should just set up a bank account, and this will allow you to sign up for direct deposits with your school, and you'll generally get money faster with the direct deposit. It's important to do that because you need to look into whether like your bank is charging monthly fees, out of network ATM fees, overdraft fees, debit card fees, all of those sorts of transactional fees. Check to see if the direct deposit helps to avoid those fees in your circumstances. Also check to see if there's any part-time employment options available to help you cover your expenses and or help pay off your loan interest, because as I said earlier, these amounts are subject to change, and it might be difficult for you to cover. Now let's talk about the repayment plans for repaying off your student loans. There's four main ones. There's standard repayment, extended repayment, income-based repayment, and graduation repayment. And essentially the difference between all of these is their term amount, how high or low of an interest option they are, and the sort of repayment plan they have. So for standard repayment, it's a 10-year term with the lowest interest option and an automatic repayment plan. For extended repayments, it's a 10 to 30-year term with an additional number of payments and additional interest paid. With income-based repayment, it's a 25-year term based on a percentage of discretionary income, not the amount owed, yields low monthly payments, but additional interest paid. And then graduation repayment is a 25 to 30-year term, which starts low and monthly payments increase every 2 years, but they yield low monthly payments, but additional interest paid. So now we can talk about if you need to defer on the loan or forbear it, what are the qualifications? Now for loan deferment, you have to be enrolled in school at least half time, and you can postpone or defer those loans for up to 3 years. The good part about loan deferment is that the interest rates don't accrue if the loan is subsidized. Unlike forbearance, where you can stop making payments temporary for qualified reasons such as illnesses, financial hardships, or service in a medical or dental internship or residency. But the issue is that the interest continues to accrue during the non-payment time. So you always want to look to defer before you forbear. So essentially, just to wrap it up, I think that the main points are that you need to understand what your major is, what college you want to go to, and after that, understand the grant options as well as the work study options before checking to see federal loans that are available for you. After you check the federal loans, you should then see if that does not cover your cost, the best and most efficient way to take on a private loan if need be. Or just try avoiding them at all costs and try getting a job, try managing your finances, using direct deposits, and being more wary of your financial circumstances. Thank you. And if you have any questions, now's the time.